Today's session is about strategy, and we'll be learning strategy from this lesson to the end. The strategy is the core factor which is necessary for trading. Now, before you even talk about strategy, there's some important things I want you to know about this platform. On the dashboard, there are three important things I want you to understand. Not three, but four. So, on this platform, we have the x-axis, this one here. I can zoom in and zoom out. This is the x-axis, and I have the y-axis. So I have the x-axis and I have the y-axis. So these axes have different purposes. So the main work of this axis is to show the time, and this y-axis is for price. So the x-axis represents the time and the y-axis represents the time, the price, sorry. So you're wondering, price for what? So this price is for this pair which you select here. I told you when you click here, you will be selecting the market you want to participate in, and the commodities you want to participate in, the various markets you want. So on Forex, let's say I want to trade Euro USD. So this price on the y-axis will be a representation of the exchange rate of Euro and USD. And when I switch to another pair, to to GBP and USD, so this y-axis is a representation of price of exchange rate between the German British pound and the US dollar. So the x-axis here is a representation of time. You see, we have June, we have May, we have April. So this is basically time. So that being said, let me explain time a little more bit here so that you understand better. So you see these time frames on the top here. We have 1 minute, 3 minutes, 5 minutes, 15 minutes, and so on and so on. We have the monthly, the weekly. So these time frames here are the ones which will dictate the x-axis. So this x-axis here depends on what time frame you are using here. So if I'm using the monthly here, this time frame will be having months. We have November, October, September, August, July, June, May. So the x-axis is now concentrating on the months. If I go on the weekly time frame, I have this week which started on date 11. I have this week that started on date 18, and I have this week that started on 25th. So the x-axis is now focusing on the week. When I go to the daily, now it will focus on the days. Now we have this day that started date 7, we have date 8, date 9, date 10, date 6, date 3, date 2, and we have April. We have not April, but we have the dates from April. We have 31st, 30. This is April going forward, and this is March. So 31st of March, 30th, 27, and so on and so on and so on. So when I go to the hours, which is the 4 hours, so this time will be constituting the 4 hours gap. So we have 16 to 20, That's a difference of 4. The margin between 20 and 20 and 24. This is the 28th date of 20. This is 28th May, and this is 00. So we have 20 to 24, which is 00. Those are 4 hours difference. From 00 to 4, those are 4 hour difference. And from 4 to 8, those are a difference of that's a difference of 4 hours. From 8 to 12, a difference of 4 hours. If I click the 1 hour, we have 7 to 8, 8 to 9, 9 to 10, 10 to 11, 11 to 12, 12 to 13, 13 to 14, 14 to 15. That's a difference of 1 hour on each time frame. Now when I go to the 45 minutes, it will be a 15 minutes gap between the two times. When I go to the 30, a difference of 30, 30, 30, 30, and so on and so on. Now, moving from the x-axis, we come here on this whiteboard you see here. So this whiteboard is a representation of the difference between one time to the next time. So this dashboard is a representation of one time frame to another time frame, the gap between two time frames. So what do I mean? So this dashboard here, or this plain board here, is a representation of 3 to 3:30 based on what time frame you are using. So how do we represent this? We represent this with this candle here. So this candle is a representation of 3 to 3:30. And what are we representing? We are representing the price change, the fluctuation of price from 3 to 3:30. I'll repeat again. So this is 3, this is 3, and this is 3:30. Why? Because I'm on the 30 minutes time frame. So this candle is a representation of this gap. And what are we representing? We are representing the fluctuation of price between the 30 minutes. I hope unanielewa. So the two time frames, they have a gap of 30 minutes, and we want to see how much or how much price changed from one value to the other on the y-axis. So for example, here, let's say this is $3. For example, don't look at this price. I'm giving you a simulated price. So this is $3 and this is $1. So the price at which this candle, we call this a candle, it's a box. We call it a candle because we have some wicks here. We have some wicks. You'll see them when I take you on the charts. Now, assume this candle opened at 3 and closed at 1. So the fluctuation in price here is $2. So the price changed with $2 now, but the time changed with 30 minutes. So we have change in time and change in price. So these candles represent the change in time and change in price. And the change in time will always be fixed according to what you have chosen here. If you choose 4 hours, the time will be fixed because you're on the 4 hours. The gap between time will be fixed because you have chosen 4 hours. and there is no option to choose price because you're making money out of price. In the market is what will dictate what fluctuation of price will be there at a certain difference of time. So price is not fixed. So we are focusing on price and time. So those are the four things I wanted you to understand. When you finish watching the videos, you can come and rewatch this section if you don't understand, and you'll have a clear understanding of it all. Now let's go back to the strategy. Okay. I told you, you see, like this candle here, I'm on the daily time frame. So this candle, the difference between when this candle opened and when this candle closed is a difference of 24 hours because I'm on the daily time frame. So it's a difference of 1 day. But the price is not fixed. The market will determine, or some geological factors, economic factors, political factors, many factors will determine the fluctuation in price. So the price dropped from 4,483 per ounce of gold to $4,312 per ounce of gold. So that was the fluctuation. But the price is not the price, but the time is fixed to 1 day. If I switch to the 4 hours, now the candles will be 4 hours apart. These candles are 4 hours apart. What do I mean? It takes 4 hours for one candle to open and close. So this candle took 4 hours to open and close, same as this, same as this, same as this. When I go to the 1 hour, this candle took 1 hour to open and close, 1 hour to open and close, 1 hour to open and close, and so on and so on. Now, let's go back to what we were to do now. A strategy, I told you a strategy is what determines if you will buy or sell. A strategy is what will determine when you will buy or when you will sell. A strategy is what will determine if you will buy or if you will buy or you avoid the market completely. The strategy is what will determine if you will sell or avoid the market completely, and vice versa. So, what's a strategy? A strategy, okay, in short, what strategy will we be using? We will be using a strategy called structure, liquidity, key levels, and time. So, SLK. Just as in the market, we have different types of strategy. Different sellers use different strategies. So, some people can be using a broker to get customers. Some people can be doing adverts by themselves to get customers. So we have different types of strategies to get profit. Now here we are using a strategy called SLK. When you go out there, you will hear strategies like ICT, you will hear strategies like SMC, you will hear strategies like um there are plenty of them, just to mention a few now. First of all, you need to understand structure. Structure. What is structure? Structure is how these candles have positioned themselves on this dashboard here. How these candles have presented themselves on this dashboard. That is structure. So, generally, in Forex, the market moves down, and also, sorry, let me draw this well. The market moves down and up. So the market doesn't move down alone, it moves down and up. So we don't have one-sided move. That's why you won't see any one-sided move here. Whenever the market goes up, it will also go down. So what do I mean by this? What I mean is, to understand the structure, you must understand the general direction of the market. So we have two directions. We have the downside move and we have the upward move. So we call this a selling move because it's going down. And when it's going down, I told you these candles are a representation of price. So it means price is also going down at this given period of time based on the time frame you are in. And when it's going up, it's a representation of increase in price at a given period of time based on the time frame you have chosen on this panel. So if I'm on the daily time frame and the market is going up, it means the 24 hours, during those 24 hours, the market has been changing price in a positive way. So the market has been changing price in a positive way, and when the market is going down, the market has been changing price in a negative way. So the market has been gaining or losing. Okay, not you, but the market. Now, inside this move, the market doesn't drop in a straight line. No, the market usually drops in zigzag forms like that. And also, in an upward move, the market doesn't go up in a straight line. It always goes up on a zigzag form. So what do I mean? Let me show you some examples. You see this upward move here. It's an upward move, but the market didn't go just parallel to the upside. It went up and down, up and down, up and down. We had an upward move, then we went down, we went higher, we went down, we went up, then we went down. Same as this downward move here, the market started going lower. We went low, then we went up again. We went low, then we went up again, then we are going lower. So when the market is going down, it goes down in a zigzag way, and when it goes up, it goes up in a zigzag way. So that is the foundation of structure. I want you to understand the basics of it first, then we go to the advanced. Now, okay, that is structure. Now, I don't want to talk about liquidity first. Liquidity will come later because for you to understand liquidity, you must have understood the structure as a whole. But I was just giving you an overview of structure. Now, let's tackle key levels. What are key levels? Key levels are levels where the market bounces from. Now, let's say this is a wall. This is a wall here. And this being a wall, you hit a ball to this wall and the wall bounces back to you. So this is a key level, which is an obstacle, which is preventing the wall to go to the which is preventing the ball to go to the other side. So this wall is a key level. Now, assume in your house you have, not assume, I know in your house you have a roof. When you jump, when you jump up, you will hit the roof and you will come down. And when coming down, you have a floor. The floor will hold you upwards. Now, this is the floor and this is the wall. So, these are called key levels where the market is being held, or where the market is bouncing from. We call them support and resistance level. So a support level is where the market is being supported upward, and a resistant level is where the market is being resisted downwards. A resistant level is a level where the market is being pushed downwards, and a support level is a level where the market is being pushed upwards. Leave alone this example because the market does not move horizontally, it moves vertical in a zigzag way. So this example is irrelevant. Now let's use this. I've told you this is a resistant level and this is a support. We call these levels key levels. So for example, you might ask yourself, why did price bounce off this level then it went higher? Why did the market bounce off this level and went lower? Why did the market bounce off this level and went high? Why did the market bounce this level off that level and went lower? And so on and so on. There are factors which lead to formation of key levels, and what we will be learning uh, as a whole concept on the strategy. So this is a key level, this is a key level, this is a key level, this is a key level. So key levels are areas where the market bounces from or is being resisted from. And now time is what we will cover together with liquidity. We will wrap up with time, then we combine all the three together. Hope you have understood the basics of structure, the X and Y axis, and this panel here, and also these candles, how they behave and what structure are they following. So on the next lesson we will study structure as a whole topic, and then the next lesson after structure we will study liquidity, and then the next lesson after liquidity we will study key levels, or I'll switch key levels with liquidity. We study key levels first, then liquidity, then we finish with time. Then now we start the serious studies about strategy, where we combine everything. In short, the advanced form of strategy where all the four are combined. So that's all for today.